Hello and welcome to another edition of Analyst Insights. On this program, we are discussing markets, we are discussing investments, and all issues that are happening in our local economy and the impact that they have on investments. And I'm joined today by my colleague Rufaro. Welcome to Analyst Insights, Rufaro.
Thank you for having me, Ranga.
Yes, so since the last time we had this show, a lot has happened, as a lot usually happens in Zimbabwe, and I think there's so many issues that we need to discuss. Maybe, maybe just to get us started, let's just talk about how the markets have performed in the last 4 weeks or so. Starting off with the currency and also the stock market. I was just checking the numbers that to end of May, that is on the 31st of May, the market capitalization, if you're using a rate of 450 Zim dollars per USD, had gone down to about 6.4 billion. At some point, we are approaching the 10 billion levels. And also even that movement in the rate itself, 450 approaching 500, considering that it was only 200 in January. What do you make of how these specific facets of our markets have actually performed so far?
So I think by all indications, whichever benchmark you want to use, whether it's the parallel market rate or the official measures, that give us an indication of what's happening in our economy from a value of the Zim dollar perspective, the trajectory is all the same. They're all these indicators are telling us the same thing, that we are back in hyperinflation. The May number for annual inflation came out at 132%, which is quite high. We are now in the top 5 in the world using the official rate. And if you use other measures, like Professor Steve Hank in the US, who prefers to use the parallel market as an indicator of inflation, that would rank us as the country having the highest inflation in the world. So I think all the indications are that we are back in hyperinflation. The trend is not looking good. If you look at month-to-month inflation, it was 21% for April. It then deteriorated. I mean, it was 21%. It was 15.5% for April, excuse me, and it deteriorated further to 21%. And it tends to be a lagging indicator. So it means that things are getting worse, and they're likely to continue to get worse if short of a policy shift that reverses the root causes of this, which is basically fiscal indiscipline.
So yes, I wanted to then ask you that, how did you get to this point? Because we've done very well in terms of bringing the number down from north of 800%, almost 12 months or so ago, to double digits kind of numbers. And the expectation that maybe we're going to end the year around 20% thereabout. How have we sort of transitioned from this being able to manage inflations to single-digit numbers on a month-to-month basis, to a situation where month-to-month inflation for the last recorded month was northwards of 20%?
So a lot of that has got to do with money supply growth. I think the last number I looked at was February. We were at 140% per annum. And whenever you have expanding money supply growth that is not being driven by an increase in production and economic growth in the economy, if it's just inflationary, then this is the root cause of the problem. And as long as we continue to see such high numbers for money supply growth, which is basically the government increasing its spending, then and liquidity in the market, then we're going to be on this path.
So what do you think is the impact of all that in economic growth? So already we are seeing the likes of the African Development Bank cutting down on their growth projection. I think they are now expecting 3.5, which maybe from figures about 5%, which even that 3.5, some really skeptical figures are saying is still very much higher than is expected. How do you see that affecting the economic projection, the economic performance in 2022, and what do we need to do to ensure that we don't get to the sort of worst case scenario that you might have in mind?
Yeah, look, I think that's an optimistic projection. I actually am of the view that we're going to suffer negative growth this year, and some of it has to do with policy action that we've taken here that has been that's bad for business and the economy. You know, for example, this growth in money supply and hyperinflation, that's a headwind for the economy. But I think also we are, you know, there are external factors that are also going to have a severe negative impact on our economy, which is the war in Europe. So if you look at the global commodity market, for example, sunflower oil, Ukraine is the largest exporter of sunflower oil. It is one of the largest exporters of wheat. And so we are actually living in a global environment where many commodities are trading at record highs. And if you look at our national accounts, you know, our imports and exports, a lot of the things on the import side of the equation are affected severely by these record high prices. So the price of cooking oil is going to go up significantly. The price of fuel at the pump is going to go up significantly. You know, the cost of doing any kind of agriculture is going to go up significantly because the cost of natural gas is at record highs, and natural gas is the main ingredient in ammonia-based fertilizers. So all of these things are going to hit us quite hard on the import side of the equation. On the export side of the equation, we are going to benefit from the higher prices, but I don't see the investments coming through to actually increase production so that we really take advantage of these high prices. So I suspect that the net effect will be disproportionately negative because the prices on the import side will go up, and we don't have alternatives. And on the export side, I don't see our production increasing materially. So we'll benefit from higher prices, certainly. But I think the net effect is that because generally we import more than we export, we're going to have a problem, which is going to be, so Zimbabweans and across the board are going to be paying more for day-to-day to get around and for day-to-day consumables, and that's a net negative for the economy. So I think that we will see negative growth this year, short of there being, some significant changes.
Yeah, so that's quite some gloomy kind of picture you're painting there, but I totally agree with you. When you look at 2022 and try to compare it with 2021, where last year we were expecting a bamba harvest, a big output from maize, and we actually achieved that. Maybe not the numbers that were being put out there in the public domain, and with a good collection from on the foreign currency receipt side and etc. And it looks like this year those numbers are likely to be much lower. So talking about the policy environment that you've spoken about, what do you make of the recent developments on the capital markets, where we have seen quite a number of directives, regulations, structural instrument whose effect was probably coming to try and sort of restrict trading activity on the market? You are a market player yourself, a broker. What do you make of the development that we've seen in the last month or two?
So I think there's this narrative out there that our capital markets are a catalyst for the high inflation that we are experiencing.
Are they not? Because these guys seem very, very much convinced that they are speculative, and also generally even the policy the policy environment is such that any activity that happens on the stock market is deemed speculative. Yes, is that correct?
So look, I'm delighted that I have an opportunity to address this question, because there's this notion that somehow speculators, people who want to buy shares this week or today and sell tomorrow or next week, that having those kind of market participants is bad, and there's a certain class of market participant called the long-term investor. That's the only kind of market participant
that's required in your market,
that we want in a market. But so the data doesn't actually support the claim that activities on a capital market translate to high inflation and devaluation of the currency. And I think just to put this into proper context, I'll use a much bigger, more sophisticated market to speak to. That is also where we've also seen some massive money supply growth over the last 10 years. And, I've recently been looking at these numbers. So if you look at, the world's largest equity market, which is the US, you saw, M2 money supply growth over the last 10 years go from about $10 trillion to circa 22 trillion today. But if you actually look at US CPI inflation, it has not moved as aggressively as the money supply growth. But what you'll find, which is quite interesting, is that there's a very high correlation between money supply growth in the US and the performance of US capital markets. The correlation is actually 0.92%. So they basically are in sync. And what happens is that all this money that's introduced into the economy ends up in the hands of capital players, and they deploy it in the capital market. And because it's in the hands of these players, it actually doesn't end up in the hands of consumers, pushing up demand for your bread and milk and the things that are in your CPI basket. So this is how an economy as big as the US has been able to significantly increase money supply without actually having CPI, because it's got a vibrant capital market that absorbed all this liquidity. And that liquidity was not out there chasing other currencies. It wasn't out there chasing day-to-day consumables. So your capital market is actually a sponge for excess liquidity. And if it's vibrant, then if money supply grows, it's able to absorb a lot of this liquidity, and it doesn't end up chasing currency, and it doesn't end up pushing CPI inflation.
But the US is not under sanctions. We are under some sanctions that we have dealt with over the years.
Look, I hear that argument in many circles, and I think that if you look at the sanctions regime over the last 10 years, or if you go back to the GNU, we were under a sanctions regime, even then, and we dollarized, and we had 5 years. In fact, actually, the economic growth that started in 2009 carried on well into 2013, 14, and 15. So it's not the case that it's been our experience that whenever we're under sanctions, things come apart at the seams. And even after the GNU in 2014 and 2015, there was economic growth with under the same regime. So if we are to look at it objectively and say, look, so what's changed, and why are we so much worse off economically today than we were circa 2014, 2015, when it was the same government, the same party holding the seat of government? It's the level of money supply growth. I think that the fiscus displayed a level of discipline in 2014, 2015 that they're not displaying today. And if they return to the discipline that we saw in 2014, 2015, I think we will see a return to lower inflation and a more stable currency.
Okay, interesting.
Notwithstanding the sanctions regime.
And probably related to that is what we have seen this week, where two of our leading financial institutions actually received some offshore lines from the European Investment Bank. It's actually, these are
Are you talking about $25 million?
Yes.
I'm amazed that that made the news, because if you go back to 2015,
not only did it make the news, we actually went there to celebrate. Some of our guys actually went to the two institutions, and apparently the events were graced by the Minister of Finance, RBZ Governor, and all. So that's quite some positive. What are you talking about?
No. It's look. I think we've got to be objective and look at these things in the proper context. So, in 2015, the aggregated bank loan book were more than $4 billion. Okay, so if you were running a big bank, you would not get onto a plane to go to Europe to negotiate a $25 million facility, right? But we have come so far, from where we were in 2015, that a line of credit for 25 million is something that we're celebrating. So it just tells us how much our banking sector has shrunk, how much how much backwards we have gone in terms of our capacity to raise money on global capital markets. Now, I'm an optimist. The way I look at it is that what this tells us is that there's so much headroom, because I believe that with the right policy framework, we can raise $1 billion or $5 billion, and we'll look back at $25 million and sneeze at it.
Okay, interesting sentiments. Thanks so much, Rufaro, for those sentiments, and to our viewers, this is what we had for you this week. Please let us know what you think about all the issues that we've discussed, things that you agree with, things that you don't agree with. And let us get your views on pretty much everything. As you can see, all that we desire is for the Zim economy to grow and for investment to come into this country. And provision of information is plays a bigger part to that whole process. So, otherwise, thank you so much for watching. Remember to subscribe to our YouTube channel and to like our Facebook page. See you next time, and bye-bye for now.